What if I told you there's one indicator that can literally show you when the market is in panic and when the market is in pure greed? And even better, it can help you time the best moments to sell puts on SPY and QQQ. It's called the put-call ratio. And if you understand it, you'll never look at market moves the same way again. What's up everyone, welcome back to the channel. If you like stock trading, options, and learning how smart money really thinks, hit that like button and subscribe. Now let's break this down the simplest way possible. The put-call ratio is calculated like this. Put-call ratio, ARS put volume, call volume. That's it. If there are more puts being traded than calls, the ratio goes above 1. If there are more calls than puts, the ratio drops below 1. If today SPY has 1,000 puts traded 2,000 calls traded, then the put-call ratio is 1,000 divided by 2,000 equals 0.50. That means call buying is dominating. Here's the key. The put-call ratio is basically a market sentiment indicator. It tells you if traders are buying puts because they're scared or buying calls because they're greedy. So in general, a low put-call ratio means traders are bullish. A high put-call ratio means traders are bearish. But here's where it gets interesting. This indicator works best as a contrarian signal, because when everyone is bullish, the market is usually closer to a top, and when everyone is terrified, the market is usually closer to a bottom. Now let's talk about what's normal for SPY and QQQ. SPY put-call ratio normal range is usually 0.70 to 1.00. Under 0.60 is extreme bullishness, over 1.10 is extreme fear, over 1.30 is usually panic. QQQ put-call ratio. QQQ tends to run slightly lower because tech traders buy calls aggressively. Normal QQQ range is 0.60 to 0.90. Under 0.55 is euphoria, over 1.00 is fear, over 1.20 is major panic. Now, here's the mistake most beginners make. They see a high put-call ratio and instantly think, oh, the market is going down, but that's not always true, because puts are often bought for hedging, not speculation. Institutions buy puts all the time just to protect portfolios. So the put-call ratio by itself isn't a magic crystal ball. You need confirmation, and that's where the best combination comes in. The best way to use put-call ratio is by combining it with 1. Put-call ratio, 1. RSI, 1. IV rank. This is the holy trinity because it tells you sentiment, momentum, and how expensive options are. If you're an options seller, you want to sell puts when fear is high, because when fear is high, puts become expensive, and you get paid more premium. So here's the high probability bullish setup. Put-call ratio above 1.10, RSI below 35 VAR, rank above 30, SPY or QQQ hitting support. This setup is basically saying, the market is scared, momentum is weak, and options are overpriced. That is the best time to sell puts, and it's the worst time to panic sell. Now here's the strongest signal you'll ever see. This is what I call the panic bottom setup. Put-call ratio above 130, RSI below 30, IV rank above 60. When you see this, the market is basically screaming, everyone is scared, and this is often where SPY and QQQ bounce hard. These are the days where people get rich selling puts. Now let's flip it. The most dangerous market is not the fearful market. The most dangerous market is the complacent market. Here's the euphoria setup. Put-call ratio below 0.62, RSI above 65 to 70, IV rank below 20. This is when everybody thinks the market can't go down. This is when traders are chasing calls. And that's when the rug pull happens. So here's the cheat sheet. When fear is high, sell cash-secured puts, sell put credit spreads, sell puts 30 to 45 days out. When greed is high, sell call credit spreads, sell covered calls, tighten stops on long positions. Here's one last pro tip. Instead of using the put-call ratio for only one day, watch the 5-day moving average, because one day can be noise, but when the 5-day average spikes, that's real fear, and when it drops low, that's real greed. So, remember, the put-call ratio is not just an option statistic, it's a sentiment gauge, and when you combine it with RSI and IV rank, you can spot some of the best reversal setups in the entire market. If you found this helpful, hit the like button, subscribe, and I'll see you in the next video.